This explainer on Canadian corporate taxation was prepared by Dr. Samir Al-Rashani with AI support. Let's begin.
Hello and welcome. If you've ever found yourself wondering just how corporate taxes work for small businesses here in Canada, or maybe you've heard the term CCPC and wanted to know more, well, you are in exactly the right place. Today, we're going to be decoding the world of Canadian corporate income tax.
So here's our game plan. We'll kick things off with the absolute foundational principle of the entire system, tax integration. Then, we'll cover some corporate tax fundamentals before diving into the main advantage for CCPCs. That's the small business deduction. We'll also look at the flip side, how the system discourages passive income. After that, we'll put all those pieces together to see how tax payable is actually calculated. And finally, we'll wrap up with a practical case study to see how it all plays out in the real world.
Now, before we even think about touching a calculator or looking at tax rates, it's absolutely crucial to understand the philosophy, the core idea that underpins Canada's entire corporate tax system. It really all starts with this one key principle.
And that principle is tax integration. Really, what it's all about is creating a level playing field. The system is designed to answer a fundamental question. Should you earn your income directly as an individual, or should you run it through a corporation? The goal of tax integration is what we call tax neutrality. In a perfect world, it means that after all the taxes are paid, the amount of cash you have in your pocket should be pretty much the same no matter which route you take.
So, that's the theory. But how does the government actually achieve this incredibly complex balance in the real world? Well, it's a bit of an intricate dance, involving different corporate tax rates, dividend tax credits for individuals, and even some unique refundable taxes. Let's start to unpack the pieces of this puzzle.
Okay, first things first, we need to lay some groundwork. We'll distinguish between the main types of corporations that exist for tax purposes, and then we'll establish the baseline federal tax rate that acts as the starting point for all of them.
So you've really got two main players on the field. On one side, you have your public corporations. Think of the big companies whose shares you can buy and sell on a stock exchange. And on the other side, you have the CCPC, which stands for Canadian Controlled Private Corporation. Now, for the vast majority of small business owners in this country, the CCPC is the structure that really matters, and so that's exactly where we're going to be focusing our attention.
So what's the starting point for federal tax? Well, it all begins with a basic rate of 38%. But Canada's provinces also need to levy their own corporate taxes, right? So to make room for that, the federal government gives back what's called a 10% federal abatement. You subtract that, and it brings the starting net federal rate for all corporations down to 28%. But as you're about to see, for a CCPC, this is really just the beginning of the story.
All right, now let's get to the single biggest tax advantage available to CCPCs. This is something that those big public companies we just mentioned, well, they just don't get access to it.
And this is it, the Small Business Deduction, or SPD. It was created specifically to provide tax relief and encourage the growth of small, active businesses in Canada. Now, there are two really important things to remember here. First, it only applies to active business income. That's the money a company earns from its main operations, not from passive investments. And second, it only applies to the first $500,000 of that income each year.
The impact of the SPD is, well, it's huge. Remember that 28% federal rate we started with? The SPD slashes that by an additional 19 percentage points. That brings the federal tax rate on the first $500,000 of active business income all the way down to just 9%. This creates a massive tax deferral, which means there's a lot more cash left inside the company to reinvest, hire people, and grow the business.
Now, of course, the government didn't create that super low 9% rate just so people could use their corporations as personal tax-sheltered savings accounts. The idea is to encourage active business. So there's another mechanism in the system designed specifically to discourage using a CCPC to just passively hold on to investments.
And that mechanism is called the Additional Refundable Tax, or ART. You can think of it as the government's way of saying, hey, we gave you this great low tax rate to help you grow your actual business, not to help you build a personal investment fund. The ART is designed to intentionally push the total tax rate on passive income inside a corporation to a very high level, often higher than the highest personal tax rate. This creates a very clear incentive for the business owner to pay that money out to themselves as a dividend.
So how does it actually work? Well, you apply a tax of 10 2/3%. The tricky part is figuring out what you apply it to. It's what we call a lesser of test. You have to calculate two different numbers and then apply the tax to whichever one is lower. The first number is your total investment income. The second number is your total taxable income.
minus the portion that already got that nice low small business deduction rate. In simple terms, this just makes sure that the ART only hits the passive income.
Okay, so we've looked at the different pieces of the puzzle. You've got the SBD, which lowers the tax on active income, and we've got the ART, which raises the tax on passive income. Now, let's put it all together and look at the complete formula for calculating a CCPC's federal tax.
All right, let's walk through this step by step. Everyone starts up at the top with a 38% basic rate. Then you subtract that 10% federal abatement we talked about. Next, you have to add the additional refundable tax on any passive investment income. After that, we get to the deductions for the active business income. For any active income above the $500,000 SBD limit, there's something called the general rate reduction, which is 13%. And for the income within that first $500,000, you get that big 19% small business deduction. What's left at the very bottom is your final Part I federal tax payable.
So that's the formula. But theory is one thing. Let's really put these rules to the test with a case study and see how tax integration actually plays out with real numbers.
So, meet Andrea. She lives in Ontario, and she's in the highest personal tax bracket. She has a $2 million investment portfolio that's generating $100,000 of income for her every year. Her question is simple. Is she better off earning this investment income personally, or should she set up a corporation to hold her investments? Let's run the numbers and find out.
Okay, first, let's look at this simple scenario. Andrea earns the income personally. If that $100,000 comes in as interest income, she'll pay about $53,500 in tax, leaving her with just over $46,000. If it's a capital gain instead, the tax is much lower, and she gets to keep over $64,000. This is our baseline, our benchmark.
Now let's trace the money's journey through a corporation. This is a multi-step process. First, the corporation earns the income and pays a very high rate of corporate tax. Look at that, over 50% on the interest income. But, and this is a really critical part of tax integration, when the corporation pays out what's left to Andrea as a dividend, it gets a dividend refund. That's the government giving back some of the corporate tax it just collected because it knows that Andrea is now about to pay personal tax on that same money. So let's see where she ends up.
And here it is, the final comparison. When we put the two scenarios side by side, the result is crystal clear. For Andrea to earn $100,000 of interest income through her corporation, it leaves her with over $4,400 less cash in her pocket than if she had just earned it personally. Even for the more tax-friendly capital gains, there's still a net tax cost of almost $3,000. This really shows us that while tax integration aims for neutrality, it's not always perfect. In this specific case, for passive income that you need to pull out of the company right away, the corporate route is actually less tax efficient.
And this all leads us to our final and most critical question. This entire system, as you can see, is a delicate balancing act. On one hand, the low tax rate on active business income creates a powerful incentive to incorporate and grow a business. But on the other, the high refundable tax on passive income acts as a significant deterrent. What this really shows is that the decision to incorporate is a strategic one. It's not a one-size-fits-all solution. It's about building a plan that fits the specific type of income you earn and ultimately your long-term financial goals.